Arbitrage is a popular trading strategy used by traders to make quick profits. It involves buying crypto on one exchange and selling it on another to profit from price differences between platforms. Crypto arbitrage trading takes advantage of the low correlation in pricing across different crypto exchanges. The most common method is spatial arbitrage, where a trader buys crypto on one exchange and manually transfers it to another. What is arbitrage? Arbitrage is a technique that involves cashing in on price discrepancies between different markets and exchanges. It is a common practice for forex traders who use software to find and take advantage of these gaps in the market. This form of trading is considered to be legitimate, although it is not without its risks. Crypto arbitrage is a similar concept that takes advantage of the differences in pricing for crypto coins across different exchanges. This form of trading can be quite profitable if the trader is able to spot these opportunities and act quickly. Often, these opportunities are limited to only a few minutes, so it is important for the trader to be able to act fast. In order to engage in crypto arbitrage, it is necessary to have a good understanding of the differences in prices between different exchanges. This can be difficult for newcomers to the industry, as there are many different factors that can affect prices. It is also important to have a solid risk management strategy in place, as this can help reduce the chances of losing money on a trade. There are several different types of crypto arbitrage, with each requiring its own unique set of skills and tools. For example, triangular arbitrage takes advantage of pricing inefficiencies between different pairs of cryptocurrencies on the same exchange. The investor starts by buying one cryptocurrency on the exchange, then trades it for a second crypto that is undervalued relative to the first. The investor then trades the second cryptocurrency back for the first, potentially making a profit. Statistical arbitrage is another type of arbitrage that uses algorithms to identify temporary price mismatches between two or more securities. This can be a powerful tool for large institutions and hedge funds, as it allows them to make quick and lucrative investments. However, it is important to note that this type of arbitrage can be very volatile and is not suitable for all investors. Finally, there are also a number of regulatory arbitrage techniques that can be used to improve the efficiency of financial markets. For example, regulatory arbitrage can be used to increase the liquidity of a stock by restructuring its structure or by outsourcing services like it. This can help to free up cash flow that can then be used for lending. How does arbitrage work? Arbitrage trading takes advantage of price discrepancies in different exchanges, currencies or crypto coins to make profits. For example, a trader might buy Bitcoin on one exchange and sell it for more on another to pocket the difference in value. This type of trading can be used in many ways and is often a core part of a broader cryptocurrency investing strategy. The opportunities for arbitrage are created by the fact that cryptocurrencies aren't tied to any traditional assets. This makes them less likely to follow the same pricing conventions as equities or bonds, which are typically priced in terms of their relation to a company, municipality, or nation. Similarly, because cryptocurrencies are digital and can be traded anywhere in the world, they can also be priced differently on different exchanges. This opens up the opportunity to take advantage of arbitrage trades that wouldn't be possible in other markets, or at least not without considerable risk. As a result, crypto arbitrage is a popular strategy among investors who are looking to add liquidity and profits to their longer-term investment strategies. A big factor in the success of an arbitrage trade is the amount of volatility in the market. If prices are too steady, there's not much room to make a profit. It's important to keep in mind too that trading costs can easily eat into any potential gains from an arbitrage trade. Arbitrage trading can be done manually or with the help of automated tools like algorithms and bots. A growing number of companies specialize in software that can automatically arbitrage across multiple exchanges for investors, enabling them to earn an attractive return on their investment with minimal effort. With the number of cryptocurrencies on the rise and new exchanges emerging all the time, there are countless opportunities for traders to spot and profit from crypto arbitrage. However, the high cost of buying and selling cryptocurrencies on centralized exchanges, CEX, can be a significant barrier to taking advantage of this lucrative strategy. That's why it's important to consider alternative exchange platforms like decentralized exchanges, DEXs, which offer lower fees and a wider range of cryptocurrencies. How can arbitrage help you? If you have been looking for ways to capitalize on the surging crypto industry, then arbitrage may be the right strategy for you. This trading method exploits price differences in different markets and has become a popular way to earn cryptocurrencies without having to invest large amounts of money. However, the process of executing an arbitrage trade is complex and requires a lot of time and resources. Many people choose to outsource this task and use online or mobile arbitrage trading apps to track prices and profits. The best tools allow you to scan the colossal cryptocurrency market and alert you when a profitable opportunity arises. The biggest challenge of using this strategy is that the market can change in a blink of an eye. This can leave you open to massive losses if you haven't hedged your positions. Furthermore, transaction fees can make or break your profit margins. If you are unsure whether this strategy is right for you, then it's important to seek independent financial advice. Cryptocurrency arbitrage isn't for everyone, but it can be a lucrative way to make some quick profits. It is also a good way to diversify your portfolio and reduce the risk of large losses. It is also important to understand the regulations in your local jurisdiction and global marketplace. One of the most popular forms of arbitrage is spatial arbitrage, which involves buying a coin on one exchange and selling it on another. This strategy is especially effective in markets with high liquidity and low spreads, and it can help you make a profit even in a bear market. Another common form of arbitration is triangular arbitrage, which takes advantage of price differences between three different coins. This strategy can be very profitable if executed correctly, but it is important to understand the risks involved before starting this type of trade. While these strategies are a great way to generate short-term profits, they should be viewed as speculative investments and not as long-term investment vehicles. The risks associated with these strategies include increased volatility in the crypto markets, high transaction fees, and the possibility of losing your investment due to a sudden market shift. Arbitrage opportunities. Arbitrage is a strategy that leverages price discrepancies between different marketplaces to make profit. It is a common technique in the footwear industry, for example, where traders buy and sell pairs of shoes on multiple platforms to capitalize on differences in prices. The crypto market is a similar marketplace with plenty of opportunities to profit from price differences between exchanges. However, this type of trading strategy is not without risk and requires a careful approach. For starters, the crypto market is highly volatile, and it is not uncommon for prices to move up or down in a matter of minutes. In addition, transaction fees, which can eat into your profits, are another major factor to keep in mind when engaging in arbitrage. Fortunately, there are a few ways to minimize the risks associated with crypto arbitrage. The first is to research the market and identify potential exchanges where you can find a price gap. This can be a time-consuming process, especially if you are new to the cryptocurrency industry. However, there are a few tools and apps that can simplify this process. These include arbitrage bots and other similar applications that will help you find the right opportunities quickly. The other way to reduce the risks is to always consider the implications of a trade before taking it. This means evaluating the risk-to-reward ratio of a trade and understanding how much you are likely to lose or gain. This will help you determine whether an arbitrage trade is worth your while. Another thing to keep in mind when doing arbitrage is that it is often best suited for experienced traders with some experience in the crypto industry. This is because many of the factors involved in arbitrage can be complicated and hard to understand for those who are new to the market.